Professor Namyong Lee's long-form commentary, Diagnosing 8 Structural Reasons Why a Second IMF-Style Crisis May Be Approaching Korea. Korea's second IMF crisis would not stem from a single event. It would emerge from a simultaneous convergence of structural vulnerabilities. The danger of such a convergence is straightforward. Each vulnerability may appear manageable when viewed in isolation, but once multiple shocks overlap, they amplify one another and can push the system past a tipping point with surprising speed. Today's long-form commentary does not prescribe remedies. It aims to scientifically diagnose only the 8 structural drivers. First, the exchange rate is already moving in a way that reflects a rising risk premium. As of January 2026, the KRW-USD exchange rate has been unstable enough that levels in the mid-1450s to around 1481 per dollar are repeatedly discussed. Compared with a roughly 1,301 average in 2023, that implies a 12,014% depreciation of the won over just 2 to 3 years. This shift is difficult to explain by a strong dollar alone. Over the same period, the Taiwan dollar is often observed to move by roughly around 5% and the Japanese yen by roughly around 10%, making the won's relative instability more conspicuous. The exchange rate is not merely the price of trade settlement. It is a market-priced indicator that compresses multiple assessments at once. Korea's growth outlook, inflation trajectory, interest rate path, fiscal sustainability, geopolitical risk, and policy credibility. As exchange rate instability rises, corporate hedging costs increase, import prices rise and feed into consumer inflation. Inflation pressures make interest rate decisions more rigid, and that rigidity intensifies the drag on growth. The exchange rate is therefore a problem in itself, but more fundamentally, it acts as a first domino that can trigger a chain reaction across other variables. Second, the Korea-US interest rate gap is structurally shaping capital flows. As of January 2026, Korea's policy rate is frequently referenced around 2.50%, while the US policy rate is often discussed around roughly 3.5%. The gap is at least about 1 percentage point. The problem is not simply that a gap exists, but that the structure makes it difficult to narrow. Korea's household debt is often cited at around 2,200 trillion won, with the household debt to GDP ratio near around 90%, placing Korea among the highest in major economies. Under this structure, raising rates to close the gap can quickly translate into higher interest burdens for vulnerable borrowers, self-employed households, and variable-rate mortgage holders, feeding directly into weaker consumption and rising delinquencies. Cutting rates may ease growth pressures, but it can simultaneously intensify exchange rate weakness and capital outflow pressure. In other words, a policy trilemma becomes entrenched. It becomes difficult for a single interest rate instrument to satisfy exchange rate stability, growth, and financial stability at the same time. Over time, markets learn this constraint. Once the market concludes that Korea cannot move rates freely, capital movements become more persistent and the exchange rate becomes more sensitive. Third, exports may look large, but the durability of the foreign currency earning structure is weakening. Even if Korea's 2025 annual exports are discussed at a level exceeding USD 700 billion, external resilience is determined not by export totals, but by the diversification and persistence of the export structure. A critical fact is that semiconductors account for roughly about 25% of Korea's exports. A structure in which 1/4 of exports depends on a single industry cycle implies that when semiconductor prices and demand weaken, the current account and the exchange rate can come under pressure simultaneously. Another structural risk is the still large share of the China market, often cited around about 18%. In an era when policy shocks, China's slowdown, trade frictions, and tighter supply chain regulations can translate directly into export outcomes, concentration in a particular market and a particular product category undermines the stability of foreign currency earnings. The more important question is not whether Korea runs a surplus or deficit in a given period, but whether it can earn foreign currency steadily even under external shocks. The current structure is becoming more vulnerable to that question. Fourth, the dual leverage structure, high household debt and high sovereign debt, reduces policy maneuverability. The combination of household debt around 200 trillion won and government debt around 200 trillion won is not merely a statement that debt is high. It is a statement that the range of usable policy tools in a crisis is narrow. When household debt is large, the side effects of rate hikes become immediate. When government debt rises, doubts about the sustainability of fiscal expansion grow. In a crisis, governments typically need to supply liquidity, deploy fiscal resources, and stabilize the financial system. A dual leverage structure makes it difficult to apply all three forcefully at the same time. In particular, when household debt is already heavy, raising rates can weaken consumption, slow domestic demand, and erode the tax base. A weaker tax base then undermines fiscal credibility. This creates a self-reinforcing pathway: household debt, growth slowdown, weaker fiscal capacity, weakened market confidence, exchange rate instability. Fifth, in real estate finance, the transmission channel is more dangerous than the headline size. Real estate project finance, PF balances, are often cited around about 130 trillion won, with over 60% concentrated in the non-bank sector. Such a structure speeds up crisis transmission because the non-bank sector can have more fragile liquidity backstops than banks, and funding can freeze faster under market stress. In addition, construction and real estate-related corporate loans are often cited at levels exceeding about 360 trillion won, implying that a property shock can spread widely from developers to builders, subcontractors, and the financial sector. PF does not end as a single project failure. If sales are weak and construction costs rise, cash flows break down, refinancing becomes difficult, bond and short-term funding markets tighten, and tighter funding conditions raise borrowing costs across the corporate sector. Rising borrowing costs suppress investment and hiring. A growth slowdown then feeds back into financial sector soundness. Under this chain, a crisis may not explode all at once. It can evolve as a sequential loss of system stamina. Sixth, geopolitical risk now functions as a macroeconomic variable. Foreign exchange markets and capital flows respond not after a geopolitical event occurs, but when the probability of an event changes. As geopolitical tension rises, demand for safe assets strengthens, the preference for dollars intensifies, and in economies highly exposed to external trade and finance, the exchange rate reacts first. Once the exchange rate reacts, import prices rise. Higher import prices destabilize inflation control, and weaker inflation control makes interest rate decisions more rigid. In other words, geopolitical risk is no longer limited to security uncertainty. It is rapidly integrated into the economic chain of exchange. Rate inflation, interest rates, liquidity. In an economy like Korea's, with high trade shares and a highly open FX market, this transmission can occur faster and with greater magnitude. Seventh, weakening policy consistency destabilizes market expectations, and the cost appears first in exchange rates and interest rates. In markets, what is most expensive is not necessarily bad policy, but unpredictable policy. When policy goals and instruments shift frequently, or when fiscal, financial, real estate, and FX messages contradict each other, markets respond conservatively. That conservative response shows up as a higher risk premium, wider FX volatility, more rigid bond yields, wider corporate spreads, and stronger pressure for capital outflows. In periods of FX instability, even small inconsistencies in policy messaging can trigger outsized market reactions. As a result, policy can inadvertently destabilize markets rather than stabilize them. In a vulnerability regime, the link between policy expectations prices becomes highly sensitive. Finally, FX reserves are compared not by headline totals, but by defense capacity relative to GDP, and in that comparison, Korea sits in a relatively disadvantageous zone. If Korea's FX reserves are around USD 430 billion and nominal GDP is around USD 1.9 trillion, then FX reserves relative to GDP are around roughly 22%. If Japan's FX reserves are around USD 1.3 trillion and GDP is in the USD 4 trillion plus range, the ratio is roughly around 30%. Taiwan, with FX reserves around USD 600 billion and GDP around roughly USD 1 trillion, is roughly around 60%. Singapore is often discussed as holding FX reserves around 65-70% of GDP. The implication is simple. In a crisis, the market first estimates how long the country can hold by looking at FX defense capacity relative to GDP. Korea is lower than Japan and far smaller in scale than Taiwan and Singapore. More important still is that FX reserves are not entirely immediately deployable cash dollars. The liquidity, speed of liquidation, and market impact differ by asset composition. In a crisis, what matters is not the headline total, but availability. Once markets judge availability to be low, expectations about defense durability weaken. Weaker expectations trigger larger FX reactions. Larger FX reactions raise the cost of defense again, creating a reinforcing loop. When these 8 factors are viewed as one system rather than separately, the structure becomes clearer. In an environment of higher FX volatility, a persistent interest rate gap makes capital outflow pressure structural. Structural outflow pressure increases the sensitivity of the exchange rate. Higher FX sensitivity makes inflation and interest rate decisions more rigid. Rigid rates increase the vulnerability of highly leveraged households and real estate finance. If real estate finance weakens, credit tightening follows. Credit tightening slows the real economy and weakens the tax base and fiscal credibility. When fiscal credibility weakens, the risk premium rises again, and the higher risk premium pushes the exchange rate up again. If geopolitical risk is added on top, the loop closes faster. And if Korea's FX reserve defense capacity relative to GDP appears weak, markets reassess defense durability more conservatively. Once that reassessment crosses a threshold, the crisis becomes not an event, but the result of structure. In short, concerns about a second IMF-style crisis do not come from one cause. They arise because exchange rate volatility, interest rate gaps, export concentration, dual leverage, real estate finance transmission channels, rapid geopolitical transmission, unstable policy expectations, and relative weakness in FX defense capacity are tightly interlinked. The danger lies not in each number by itself, but in the acceleration that occurs when these numbers begin moving together. That acceleration is the core of the crisis structure. One further point deserves emphasis. In late 1997, under President Kim Young-sam's administration, the leadership, ignorant and incompetent, insisted that Korea had no problem because the fundamentals are sound, even as a tsunami of currency crisis was rolling in from Southeast Asia. That bitter, tear-soaked lesson must be remembered. Taiwan, among others, did not experience an IMF crisis at that time. Only when the public awakens can this country survive. Thank you for reading Professor Namyong Lee's long-form commentary.